At its core, a commercial bank operates as a financial bridge. It exists to move capital from individuals and institutions with surplus funds directly to those who need to borrow them. To build this bridge, banks first acquire capital. They accept cash from individuals and businesses in the form of deposits. On the bank's balance sheet, these deposits are classified as liabilities, money the institution legally owes back to its customers. The bank then puts those deposits to work. It issues loans and advances to other individuals and corporations. These loans represent the bank's primary assets, generating consistent revenue over time. The entire business model relies on the spread between these two flows. The bank pays a low interest rate to depositors and charges a higher rate to borrowers. The mathematical difference between loan revenue and deposit cost is net interest income. Ultimately, a commercial bank is an economic engine designed to profit off the spread between the cost of the liabilities it holds and the yield of the assets it creates. This engine, however, relies on a structural tension regarding time. The deposits that fund the bank are mostly short-term and highly liquid. Customers expect to withdraw their money on demand. The loans, meanwhile, are long-term and illiquid, tied up in multi-year mortgages or corporate debt. This creates a perpetual balancing act. A bank manager is incentivized to issue as many high-yielding, long-term loans as possible to maximize profit. But if too much cash is locked in long-term assets, a sudden wave of customer withdrawals will rapidly drain reserves, triggering a catastrophic liquidity crisis. We saw the absolute limit of this tension during the 2007 to 2009 global financial crisis. Financial institutions prioritized aggressive asset expansion and neglected their liquid buffers, causing the entire credit system to freeze the moment market panic set in. To prevent this cycle, modern bank management revolves around four strict pillars: ensuring sufficient daily liquidity, managing asset default risk, controlling liability costs, and maintaining adequate capital protection. Left to market forces alone, the drive to maximize yield pushes banking institutions towards insolvency. The global financial system relies on strict external regulation to force banks to protect themselves from their own profit models. To see how these regulations are applied, we have to look inside the accounting architecture. Every commercial bank operates on a foundational equation. Total assets must exactly equal its liabilities plus shareholders' equity. On a standard balance sheet, liabilities and equities show sources of funds, like customer deposits and shareholder reserves. Moving to the assets column, we see how funds are deployed: highly liquid cash reserves at the top and illiquid, profit-driving loans further down. The income statement tracks asset cash flows. At the top, interest expenses are subtracted from income to yield net interest income before deducting operational overhead. Crucially, it also deducts allowances for non-performing loans, subtracting expected losses from defaulted payments directly from operating profit. A balance sheet and an income statement map out the bank's baseline strategy and current profitability, but they do not explicitly calculate the institution's exposure to an unexpected systemic economic shock. That exposure metric is defined internationally by the Basel Committee on Banking Supervision. Through a series of sweeping accords known as Basel I, II, and III, this committee sets the global standards for capital adequacy, dictating exactly how much emergency capital a bank must hold. These international standards are enforced by domestic regulators, like Bank Negara Malaysia, to guarantee stability and protect local depositors from institutional failure. Under these rules, a bank's capital is divided into specific tiers based on reliability. Common Equity Tier 1, or CET1, represents the core funding. This includes ordinary shares and retained earnings, the highest quality, most liquid assets to absorb losses immediately. Tier 2 capital acts as a secondary buffer, consisting of supplementary, slightly less liquid instruments like hybrid capital and general loan loss provisions. Regulators define capital as a mathematical equity buffer, calculated specifically to absorb sudden credit losses without threatening the stability of customer deposits. To determine exactly how large that capital buffer needs to be, regulators look at the bank's asset portfolio. But a 100 million ringgit government bond carries vastly different risk than a 100 million ringgit personal loan. To account for this, every asset class is assigned a risk weight, from 0% to 100%, based strictly on its probability of default. If a bank holds 4 million ringgit in repos issued by an OECD central government, the risk of default is virtually non-existent. The asset is weighted at 0%. Moving up the risk curve, 9 million ringgit in highly rated Kagamos debt securities carries a 10% risk weight, adding 900,000 ringgit to the tally. For residential mortgages, the default risk increases. A 30 million ringgit portfolio, weighted at 50%, adds 15 million ringgit to the total risk equation. By tallying the weighted values of every asset, the bank calculates its total risk-weighted assets. In this specific portfolio, the final calculation sets at 15.9 million ringgit. This figure dictates the regulatory floor. Under the Basel Framework and Bank Negara Malaysia guidelines, a financial institution must maintain a total capital ratio, its Tier 1 plus Tier 2 capital, equal to at least 8.0% of its total risk-weighted assets. The RWA calculation mathematically throttles excessive risk-taking. Issuing higher-risk, high-yield loans forces the bank to hold proportionately more expensive equity capital to cover the fallout. We can see how this structural matrix works in practice by evaluating the 2024 financial statements of KKBC Bank. Looking at the Statement of Comprehensive Income, the bank generated a net profit of 1.68 million ringgit. When we measure that net profit against the bank's total assets, we get a return on assets of 2.1%. However, when measured strictly against the shareholders' equity, the return on equity jumps significantly to 16.8%. That massive multiplier between the asset return and the equity return is driven entirely by financial leverage. KKBC Bank is generating high shareholder returns precisely because it is using borrowed depositor liabilities to fund its asset growth. To ensure that leverage isn't creating a dangerous liquidity trap, we check the loan-to-deposit ratio. By dividing the 50 million ringgit in loans by the 60 million ringgit in customer deposits, we arrive at a safe ratio of 83.33%. KKBC Bank's high profitability is built on aggressive leverage, but it remains structurally sound because it funds those loans with a stable, sub-100% core deposit base, rather than relying on volatile, short-term wholesale borrowing. Turning to asset quality, the bank demonstrates highly controlled credit risk. Its non-performing loan ratio sits at a minimal 0.4%.